All right, guys, so we're going to jump in here with lesson 2 on risk management. So, as we've already talked about for students who have gone through the Warrior Pro or the Warrior Starter course, you guys watched class 2, which was all about risk management. So, you're going to be familiar with some of the concepts. However, in this class, we're going to get into a little bit more of how risk management applies to trading cryptocurrency, because in a lot of ways, you're going to find that trading cryptocurrencies does carry more risk. And as well, just one example of that, last year on one of the days when the cryptocurrency markets dropped by like 20%, people trying to log in to their accounts so they could sell their positions, they couldn't even log in because the broker websites were crashing. And so, it's one of those things where I don't think that would ever happen with, E-Trade and Ameritrade. I think there's just so much regulation on the quality of service they have to provide that wouldn't happen. But, with this crypto space being a little bit unregulated, that was definitely happening. And there were other people complaining that they tried to withdraw money from their accounts, and weeks had gone by and they hadn't heard what was going on. And it wasn't because the money was gone. It was just, there was a backlog. These companies were just inundated with support tickets because of the volatility that we saw in the second quarter. And so, it made people feel a little bit uncomfortable, and something just to be mindful about, that when you're trading cryptocurrencies, this is not, the market right now, like the stock market, where you have deposit insurance and you can feel confident that the brokers are regulated. It's a little bit of the Wild West. So there's a lot of opportunity, but also have to be mindful of the higher levels of risk. So today's topics: what is risk management as it pertains to cryptocurrencies? Why is it important? What are the types of risk that you'll encounter? How do you manage your risk? And some examples of risk management in trading. And again, I want to remind you guys that everything you're learning right now, you can apply back to trading stocks. So this will be a little bit of, reiterating the concepts that you probably already know on risk management. But one of the things that I've learned is that you have to sometimes hear things multiple times to really get it to sink in with you. If you just kind of hear it once and then that's it, you don't always retain it. So I really want to hit home the importance of risk management, because this is one of the most critical components to long-term success in the market. All right, so let's get into this class here on risk management. We'll start with a slide here that Arsh can jump in on.
Yeah, so I absolutely agree with you that risk management is the most important fundamental concept of trading. And this is a quote from Paul Tudor Jones, who I think many will agree is one of the best traders to have ever lived. He famously predicted the 1987 Black Monday crash and made nearly 200%, or $100 million on the day of the crash, while practically everybody else on Wall Street was losing their shirts. He
That's
said,
crazy.
"I'm always thinking about losing money as opposed to making money. Don't focus on making money, focus on protecting what you have."
Yeah.
This quote practically summarizes risk management in one sentence. Personally, as somebody who's had a tough start to trading because of failure in risk management, this quote had a significant impact in helping me to achieve trading success. You should never be focused on what you stand to make. Rather, you need to be focused on what you stand to lose. And you need to ensure that no single trade is going to considerably harm you and put you out of business. It
Right.
happens nearly on a daily basis in the markets, unfortunately. But if you master the concept of risk management, you can ensure that you are not putting yourself in that danger.
Yeah. One of the things that I've said in some of our other classes is that gamblers can start to think about the profits. You start thinking about all of the potential, and you're not thinking about the downside risk. And that's why, you keep doubling down, you keep going more aggressive. And with trading, it can get you into such a bad situation if you start to snowball, where all you're thinking about is the potential to profit. Because you have to realize that every time you take a trade, you're taking risk. However, you can choose how much risk you're willing to take. And the very fact that you can choose means that you can take risk in very small amounts. So a lot of people will say, well, geez, trading is risky. Cryptocurrency trading is incredibly risky. It's actually only risky when you don't understand how to manage risk. Because when you know how to manage it, you can make the decision to say, on this trade, I'm only risking $500. And you, of course, do the analysis of, well, if I risk 500, that's my max loss. But if the trade works, how much will I make? And we do our technical analysis. Let's say the potential for profit is $1,000. That's a 2-to-1 profit loss ratio. That's a trade worth taking, right? But if you look at something and you're like, oh, I'm gonna buy 1,000 Bitcoins because this thing could go back to $20,000. And then what do you do when it drops 5 points and you're losing more and more? You're losing thousands and thousands. Well, all I was thinking about was how much I could make, not how much I could lose. And that's how you back yourself into a corner. And like Arsh said, every single day there are traders who are blowing up accounts. And that's why it's so important for you guys to practice trading in a simulated environment so you're not risking your hard-earned money on trial and error. You don't want to put hard-earned good capital at risk until you've proven that you can be profitable. So, when it comes to thinking about loss, all of the big guys, Peter Lynch, who famously ran the Magellan Fund at Fidelity, he was an incredible trader, so focused on managing risk. Bill Ackman, Carl Icahn, Warren Buffett, all of these big investors, they're obsessed with minimizing loss. They think about losing money every single day. They're so obsessed with it that they've turned losing money into making money because they're just obsessed with minimizing the loss as much as possible. The reality is, if you lose half of your account, if your account goes from 100 grand to 50 grand, you now have to make a 100% profit to get back to break even. And to make 100% is usually going to take 7-8 years for most traders. It just doesn't happen overnight. So you have to be really mindful of the risk you take on every trade. Don't be a bag holder. All right. So what is the definition of a bag holder? You want to tell me a story of Jimmy, your friend Jimmy?
Yeah. So my friend Jimmy, he went to a party not too long ago, and he heard a couple of his friends talking about Ripple, and they were thinking about taking a trade on it. So he actually hadn't heard of what Ripple was, but when he overheard them talking about how it had nearly tripled over the last month, he became extremely interested. He had some money set aside, saved, that he was actually saving up for a new car, but he decided that it would be pretty wise to invest in Ripple, as that could help him potentially buy an even better car. So, but the problem with the situation was that he never thought about the risk management side of taking a trade or an investment. He never thought about taking a loss on what he invested, or at what point he was going to cut the loss and admit that he was possibly wrong. Unfortunately, Jimmy didn't make that decision, and he drew his account down by 70% as he bought Ripple around $3, and it went all the way down to $1, and he stared in disbelief as he watched the price just go against him. And unfortunately, you don't want to get stuck in that kind of position because it can just completely demolish your trading career. You can be out in one bad trade, and without the trading capital, there's no way for you to return and take another trade. So you can't become a deer in the headlights and freeze under the pressure when you're taking a hit. You need to retreat and exit your position and then reevaluate the situation. And maybe there is a reason to get back in, but you really need to make sure that you're cutting that loss before it gets to the point where it's just so big that now you don't know what to do and your trading career is potentially over.
Yeah, and I've absolutely had moments in my trading career where I took a high risk trade. I was thinking, I had dollar signs in my eyes. I was thinking about all the potential, and I buy a stock as it's going higher, 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 and next thing I know, boom, the bottom falls out, and I'm suddenly down $10,000, and I'm just staring at it like, oh my God. What do I do? And the fact that I got myself into that situation, by being greedy, by not managing risk. And now I'm in this, holding this big loss. And the problem is that when you're holding that loss, emotions start to take over, and you're no longer driven by your rational mind, you're driven by your emotional mind. And so you start doing different things. Like for me, on the worst trade I ever took, I got in and I was instantly down $5,000. And I was like, whoa, that was insane. So what was my instinct? I decided to buy more shares. I bought more because I thought that if it came back up, I might be able to get out halfway between my first entry and my second entry for break even. And I was wrong. It kept going lower. It went down and I was down 10,000. I added more shares and it kept going down more. I ended up losing $25,000 in one trade in about 10 minutes. It happened that fast.
It's really tough to admit you're wrong sometimes, right, Ross?
Yeah, well, that's exactly
when you're in trade.
Yeah, that's the thing that's really hard is that you don't want to accept defeat. You don't want to admit that you're wrong. You don't want to take the loss. You don't want it to be real. You're hoping maybe it'll turn around. And the thing about being in that situation is, it's like you suddenly, it's almost like, my dog's sleeping over here in the corner. If I suddenly pick her up and I throw her, out into a pen with 40 other dogs, it's like, oh my god, what's happening? It's just out of nowhere, all of a sudden you've got to react, and she's a nervous dog, so she wouldn't react well. And so for me, all of a sudden, out of nowhere, I just totally unexpectedly came into this huge loss. I'm not prepared for it. I didn't plan my trade. And so you look at the chart here on Ripple and you can see from a high of 330 back down to 75 cents. I mean, that's a really big drawdown. And the reality is smart traders who, took this trade in this area right here on this pullback at 75 cents, they did awesome. Selling it up through here, buying more down here around $1.25, selling through $1.30, buying more at $2, selling through $3.20. But the traders who bought here, they certainly would have lost money, but they could have minimized the loss by having a max loss set. But a lot of beginner traders that are in the cryptocurrency space, and by no fault of their own. I mean, we don't get trained on how to trade the markets profitably in school. This isn't part of our, high school graduation. We have to figure, if we want to learn it, we have to figure it out on our own. Most of us do it through trial and error. We do it through losing money, the same as I did. And you just hope that on the other side of those losses, you've learned lessons. And our hope is that by you taking these classes, you'll learn the lessons that we paid that high cost for, and you learn them before you have to actually take the losses. So you can learn through our mistakes and through Jimmy's mistakes, because poor Jimmy, he really took quite a beating on Ripple. So don't be a bag holder. That's the major lesson, would you say?
Yeah, I definitely agree. That's probably the worst mistake you could make as a trader.
Yeah. I have, a lot of friends who've gotten into trading, and some of them, if they got into a trade and it didn't work out right away, they'd say, you know what, I'll just hold it. I'll hold it. I don't want to sell it. They end up holding it for days, for weeks.
Right.
And look what happens on a stock like Ripple. You hold it for weeks. Some stocks just simply don't recover. Now this, who knows?
Right.
Maybe this will recover. Maybe in a year this will be at $6, but maybe it'll be at 10 cents. And
yeah, you know what? Like, say, let's take for example, you had seen when Ripple was going up to $3. Maybe, yeah, it maybe did have the potential to go to $6, but
sure.
You really have to incorporate that risk management and tell yourself, at what point am I going to cut this trade if it doesn't work in my favor, because it could completely go the opposite direction, right?
Yeah.
So it's really important to make sure that you always have that stop loss before you take any trade, and you really have to make sure you don't let a bad trade spiral out of control into something that it doesn't have to be.
Yeah, and potentially something that it will be very hard to recover from. So don't be a bag holder, all right? What is risk management? Well, go ahead, Raj, yeah.
Yeah, so by definition, it's the estimation and evaluation of financial risks and the minimization of their impact. So what that really means is that you're taking the steps to ensure that you know precisely what you stand to lose on every single trade that you take. You also have to make the decision that this is an acceptable risk to take relative to your account size.
Right.
So what that means is you can't decide to risk, say you have a $10,000 account and you see a great trade, you can't risk $2,000 on that one trade and then decide to risk $5,000 on the next. You have to keep a consistent max loss across all of your trades. Right. So this is one of the most important aspects of trading, and it should be every trader's number one priority, because a lack of risk management is the leading reason that most traders fail in the markets. They don't give themselves the chance to achieve success because they blew up their account within potentially a handful of trades where
Right.
they took major trading losses. I know some traders that have blown up their account in just one trade because they
Hmm.
just kept adding size and they were unwilling to cut the loss.
Right.
The problem that most traders face in the markets is that their winners are too small and their losers are too large. And unfortunately, you're not going to be able to be profitable that way. You really need to. The best way for you to achieve that profitability is to ensuring that you're keeping your losing trades very small while you're giving your winning trades the potential to work out even more in your favor. So that what that really helps accomplish is your winning trades help pay off for all of the small losers,
When
and
you
you
do
still
get
have
that one big winner. Yeah.
right, and then you still have profit on the side.
Right. Yeah.
So
One of the things you mentioned there with the size of the losses, it's possible to be a trader who's right 95% of the time and still loses money, because if on that 10th or 11th trade you decide to go out and risk $10,000, it doesn't matter that you made 500 on the last 9 trades. You risk 10,000 on trade 10 or 11 and boom, you're done. You're out. You're 95% accurate and you still lost money, and it's because you didn't evenly weight your risk across all the trades. So yeah, some trades you may think, well, this trade has more potential, I can risk a little bit more, and that's okay within reason, but you don't want to be taking 10 times more risk on trade 1 versus trade 2, because then those winners and losers, they don't balance each other out when you average your trades over a long period of time.
yeah, definitely, it's okay to step on the accelerator when you see a really great trading opportunity, and maybe it's okay to risk a little bit more than you normally do, but you never want to go too far outside of your normal risk range, and
Right.
because what that could just lead to is if you're wrong on that trade where you risk so much money, you're going to get back a month's worth of gains, potentially
Right.
more.
Yeah. And I've done it. And the problem with when you do have that big loss is that you now have to sit down and admit, I have to start rebuilding. And so the analogy that I sometimes talk about is building a house. And if you're a contractor and you're building a house and someone comes along and knocks down a quarter of the house, so you've got it almost all done, someone comes down, knocks down a quarter of it, you can't just push it back up in 1 hour. You have to just go back and rebuild it one piece at a time. And imagine if on every job you ever worked on in your life as a contractor, a quarter of the job always got knocked down and you had to rebuild it. That's what it's like to be a trader, because we always fall down. We fall down on a weekly basis. There's no such thing as a trader that's not going to be read, on average, at least probably 2 or 3 days a month. It's part of the job. So you have to get good at falling down and being able to get yourself back up. But it also means that we control how we fall. So we don't let ourselves snowball, because we know that we're going to have to rebuild. And the process of rebuilding, when you knock down 75% of the house, is it's going to take you so much longer. So when you start to feel that things are falling and that you're about to have this loss, you want to cut it as quick as you can and already start thinking, okay, I'm going to take the loss, but then I got to start rebuilding. Because if I just let that loss get bigger and bigger and bigger, it's going to make the rebuilding that much longer. Because you eventually have to rebuild, right? Eventually you'll close the trade, and now you've got to start building back up. So you want to make that process as easy as you can, and that means keeping those losses really small.
Yeah, and as you mentioned earlier, when you take a 50% loss, it takes
Right.
a 100% gain to get back to where you are. So that
Yeah.
rebuilding process can be incredibly stressful and tough. So you
Yeah.
never want to be in the position where you're taking such big drawdowns that it's so tough to get them back.
Yeah. Right now, my drawdown, my peak drawdown is about 15% of my account. So if I go to, I have a $100,000 account, I would draw down 15,000. And that for me is, that's a pretty big step forward. If each step up is $10,000, that's like a step and a half back. But if you think of that as a curve, 10 steps up, 1.5 steps back, 10 more steps up, it's okay. But you definitely don't want to have 20, 30, 40% drawdowns, because then it's going to take you so much longer to curl back up. So definitely something to keep in mind. Again, doesn't matter whether you're trading cryptocurrency or stocks or Forex or futures or whatever. All right, so why is risk management so important? You can lose a large portion of your equity very easily without risk management. As my $25,000 loss goes to show, I have over $895,000 in losing trades that I could show you that were the cumulative losses of years of trial and error. Just all of the losses over several years added up. It's incredible how fast you can lose money. And I was lucky during that trial and error process that, I was for a while kind of break even. So I made back the losses, but, it's just part of the deal with trading that you can have really big mistakes and essentially blow up mistakes it can happen in a matter of minutes. I'll bring up a chart here to show you guys. It'll be an intraday chart, and I'll show you. You can of course see on Ripple. This is a daily chart, so it wasn't the drop here wasn't maybe as rapid as we've seen on other stocks, but I'm going to show you an example of this stock that we traded. Let's see, it was about a month and a half ago. And the stock dropped so quickly that traders, they didn't even have time to react. And I heard of several traders who blew up their accounts on this trade that I'm about to show you. It's a sad thing when that happens, but it's an opportunity for you as a beginner trader to learn a lesson and hope that you don't repeat those same mistakes, that you're able to really understand the leading causes of failure. They are risk management. So how do you manage risk on all of your trades? How do you avoid being stuck with holding the bag or deer in the headlights? So the stock will be LFIN. We're going to go back. This is a 5-minute chart. So this is the day where this stock went from $40 a share to $140, $150, which is obviously absolutely crazy. Look at this. The stock's just going up. And so what were people doing? They were buying. It's going up, going up, going up. It tops out all the way up here at $140. But what does it start to do? What color is that candle? It's a red candle. It started to turn around, and I'd never seen a drop like this. It dropped from $125 all the way down here to 60. It opened at $59 a share. It dropped in half. That was in 10 minutes. And so think about that.
Insane.
Imagine if you were holding 3,000 shares. You just lost over $100,000. It's crazy. So a momentary lapse in judgment, a momentary, giving in to FOMO, the fear of missing out, and saying, everyone's making money on this thing, I'm just going to buy it, I'm just going to jump in. And that's the risk that could happen. And, that's one example. There's another one here. This is a stock that went from $240 a share, and it resumed at $46. It resumed at $55, from $230 to $55. This is the next, it wasn't the next day. The New York Stock Exchange, NASDAQ, halted trading of this company because they didn't understand why it went from $25 to $225 in 4 days. So they halted trading of the company. They said no one can buy and sell shares of it. It finally resumed trading 6 months later, and it was down over 75%. And so, imagine if you had 1,000 shares of this, that's almost $250,000. And I know that there's people that were. And it's a momentary lapse in judgment, and then boom, that's what happens. So go ahead.
Sorry. Yeah. So I would think that what this should really go to show you guys is that there's definitely the possibility of taking bigger than expected losses in the market, and that's why you have to be very vigilant at all times about how much size are you taking, and so that you can ensure you're never in a position that's too big, and a position that might result in taking a much bigger than expected loss.
Right. So one of the things for me, I don't trade on the couch. I don't trade sitting in my pajamas, laying in bed. When I'm trading, I'm at my computer. I'm taking it seriously. I come in here to focus for 2 hours a day. Those are my hours, 9:30 to 11:30. That's when I'm really at peak performance. And by noontime, by 1 o'clock, my mental capacity to maintain that level of focus is gone. And I don't trade in the afternoon because I don't make good decisions. Because the reality is that little momentary lapse in judgment, and I've had many of those momentary lapses in judgment, enough of them to tell you that they have added up to hundreds of thousands of dollars in losses. You have to be so disciplined. So we'll talk a little bit more about how to be a more disciplined trader in a second. But remember, every trade has the possibility of being a winner or a loser. So think first about how much the risk is, and then ask yourself, how much is the potential profit of this trade, and is it an A quality setup? We trade the best and we leave the rest. All right, so let's see. Arsh, I'll let you take it on the next slide here.
Sure. So let's get into some of the types of risks that are involved with trading cryptocurrencies. So three major risks currently would be volatility risk, headline news risk, and 24-hour trading risk. So volatility risk really results from the imbalance in supply and demand, and it leads to constant fluctuations in price. So the price volatility is a major risk in every trade you take, and you have to determine how much you're willing to lose before you take the trade. So say you buy Bitcoin at $10,000, there's a very real chance that it may go against you, and it could go to 9,000, 8,000, 5,000, or it could even go in your favor to 12,000, 15,000, right? There's the price volatility risk that results in a uncertain outcome. But
Right.
as traders, we really have to minimize the risk and make sure that if we are wrong, we're not taking too large of a loss. So volatility risk is definitely one to always be vigilant about. Also, there's the unfortunate risk potentially of having headline news come out on something that you may be trading. Say you're involved in a Bitcoin trade, and all of a sudden the U.S. government comes out with regulatory news and says Bitcoin is no longer allowed in the United States. That could cause
That could be huge.
that could be huge, right?
Probably
That could
won't
result in
happen, but something like that.
Definitely something, very low chance of something like that happening. But we have to be aware that there is that risk of news coming out that could potentially affect the trades that we're in. And this is something that's just, it's chance, of course. You can't predict it happening, so you just have to be vigilant about it and just know that that's a possibility. And then, of course, there's the risk of 24-hour trading. So this stuff doesn't stop trading. It keeps going 24 hours a day, 7 days a week, and that means price is constantly on the move. So if you're holding a swing trade, you have to make sure you have stop losses in place to ensure that the price doesn't go against you more than you expected. It's not possible for you to be in front of your computer at all times, right? So
Right.
it's incredibly important that you place stop losses or some kind of mechanism to prevent you from taking a bigger than expected loss while you're awake.
Yeah, and that's one of the challenges, obviously, with the market right now. We know that stop orders for day trading stocks don't work after hours. So there is always the risk that you're holding a stock after hours that drops and your stops don't trigger. When you trade options, you can't trade them after hours. So a stock drops after hours, there's nothing you can do. So that there is some risk there with the regular market anyways. But with 24-hour trading, if you didn't have a stop, what if there was a flash crash in the middle of the night? Something happened in Europe or in Asia, you weren't aware of it, and you wake up and you're down 50% on your account, right? So that's why we have the stop losses that we use on our trades, because it helps us mitigate our risk. So when we go into GDAX, one of the things that we're able to do here is if you're holding a position, you can set a stop order. And so you say what the stop price is, and you say the amount of your order, which would be based on your position. And now you've got a stop price set. That's your line in the sand. It goes below that and you're out. And it doesn't matter. That's the nice thing about 24-hour trading, is that you don't have to worry about after hours or pre-market. It goes below that price and you're going to come out of the trade. So you're minimizing your downside loss by using those types of orders, which is definitely an important component to managing risk. All right, let's see. So how do you manage your risk? So one of the things that we talk about is never losing more than your predetermined max loss. And this is to say that you don't want to adjust your risk tolerance to accommodate a losing position. So if you're in a trade and suddenly you're down $500 and $500 was your max loss, you should be pressing the sell button. But a lot of traders, they hold it and they're like, well, I'll give it a minute. Next thing you know, it's down $750, or it flushes and it's down $1,100, and now they're back to deer in the headlights. And how did this happen? I was supposed to only have 500, and all these thoughts are going through their head. Meanwhile, it's still dropping. It's down 1,400, 1,500. So you have to just respect your max loss. And so one of the ways that we help really encourage beginner traders to just make this just like a habit is to use stop orders, because the stop order will determine your max loss. The only problem with stop orders is that you do have the risk of slippage. And this is especially true on more thinly traded stocks and potentially more thinly traded altcoins. Not the big coins like Bitcoin, Ethereum, or Litecoin as much, but some of the altcoins. And so slippage is basically your stop order goes, let's say you had it at 900, but then the stock drops so fast that you don't get filled on the order until like 850 because it's in the middle of a flash crash. And that's part of the risk of trading, is that if you're selling when everyone else is selling, there aren't a lot of buyers, and so stocks can obviously, drop really quickly. So stop losses are critical, but you also have to remember that there's risk on them. So you shouldn't think that the stop loss should justify just getting into anything. We still only get into trades that have A quality potential, which we'll break down when we talk about technical analysis, and that have the potential to double your profit versus your risk. You risk 500 to make 1,000. You risk 5,000 to make 10,000. It doesn't matter what the dollar amount is. It's about the ratio. Now, staying emotionally detached and taking the proper position size are kind of one and the same, because one of the things that I've found is that when I start taking bigger position sizes, the emotions start to flare up because more money is on the line. So you start to feel more pressure, more stress. If this goes wrong, it's going to be a big loss. It's going to be really hard for me to bounce back from it. And so as a beginner trader, starting with smaller position sizes is really important. And that way you can kind of condition yourself to stay detached. Of course, being disciplined is absolutely key. We're going to talk more about that in a moment. And trading the best opportunities is, we have to trade the best. We trade the best and leave the rest, because the reality is, even for me, when I trade the best quality setups, I'm still only right 72%, 73% of the time in my best months. That means I'm still wrong a quarter of the time, which is okay. But if I started trading even just B quality setups or C quality setups, my accuracy would go down really quickly. And then I'd occasionally get into those trades where, suddenly it flashes through my stop. And now I have a big loss, and it was on a B quality trade and it wasn't even worth it. And now I've got to dig myself out of the hole. So just focus on trading the best quality setups and you're going to be in much better shape.
Yeah, definitely. So incorporating all of these steps into your trading will really help you minimize your risk. And we'll dive into each one of these a bit more in detail. We'll start off with max loss. So
Sure.
before you begin trading, you need to determine a max loss you're willing to take on any single trade in terms of dollars or whatever other currency you may be using. So you should keep this max loss consistent across all of your trades, meaning that all of your trades share the same max loss, the amount that you're willing to lose. There should never be a case where you're consciously allowing yourself to take a loss that's greater than your max loss. So it's recommended that you risk no more than 1% of your total account size on any single trade. And that means if you have a $10,000 account, you would be able to risk $100 per trade. And you should never be losing more than $100 on any given trade. Mm-hmm. That's part of your max loss risk management rule. Keeping your max loss consistent across all of your trades is going to help you ensure that all of your trades have the potential to offer similar profit loss ratios. You don't want one trade to if you're risking too much on one trade, that trade could be a much bigger loss than the gain that you've had on the previous trade, and it's not gonna. Sorry, totally messed that up.
That's okay.
Let's start that slide again.
Okay.
Yeah, when I start I have my talking points, and when I start incorporating some of my own thoughts, that's when I kind of stumble over my thoughts. So maybe I should just stick to what I've written.
You can do whatever you want. I mean, I do that too sometimes. I do that especially when I'm trying to record videos, like I'm doing like ads for Facebook. If I go
Yeah,
off script, I get myself confused. But yeah,
yeah, that's what I
in the
seem to have been
webinar,
doing here.
it's hard. It's okay though. All right,
Okay.
so go for it whenever you're ready.
Yeah, so incorporating all of these steps into your trading are really going to help you minimize your risk so that you can be confident that no single trading loss is ever enough to damage your account.
Right.
And we'll get into each of these steps in more detail here, starting with max loss. So before you begin trading, you need to determine a max loss that you're willing to take on any single trade in terms of dollars or whatever other currency you may be using.
Yeah.
So you should keep this max loss consistent across all of your trades, meaning that all of your trades share the same max loss. There should never
Right.
be a case where you're consciously allowing yourself to take a loss that's greater than that predetermined loss. So if you have a $10,000 account where you're willing to risk 1% per trade, that means you can risk $100 on the trade, and you should never be losing more than that $100 on any given trade.
Right.
So keeping your max loss consistent across all of your trades helps you ensure that all of your trades have the potential to offer similar profit loss ratios.
Yep. Yeah, that's exactly right. And like we said before, you don't want to be the trader who's right 95% of the time and who's still losing money because it's because you mismanaged your risk on one trade and you allowed one to go far beyond your max loss. So stop orders, as I already showed you guys in GDAX. One of the things that you say here is that you should never take a trade without a stop loss. I personally use mental stop orders, and I use these for a couple of reasons. One, as a trader who's been doing this for a long time, I feel more comfortable using my own mental stop, which is I have in my mind, this is my max loss, and if the stock goes below that, I sell. I feel more comfortable doing that than using a mechanical, like an actual sell stop order. And it's just because I've had times where I got into a trade, it dipped down for a second, stopped me out, and then ripped back up. And so for that reason, I don't use them, but I really think that as a beginner trader, for building that consistency of taking the small losses, it's important to use stop orders, and especially with cryptocurrencies because of how volatile they can be and because your risk for downside could be 50%, you really want to minimize that as much as possible. So we'll talk about learning how to pick proper stop order locations in the technical analysis lesson. So you're not putting an arbitrary stop where you're more likely to get stopped out prematurely and then have the stock squeeze back up. But again, failure to obey your stop loss can result in major trading losses. So if you're going to use a mental stop, it's only as good as the person who's enforcing it. So you have to be disciplined enough to stop out when you come down on that max loss.
So position sizing is the next important concept of risk management, and you should always size into your trades based on what your predetermined max loss and your stop loss on the trade was. So
Right.
by incorporating both of those variables, you'll be able to determine how big of a position to take on the trade. So for example, if you think Bitcoin's a good buy at 10,000, but you know you would want to exit if it hits 9,900, that means you're risking $100 per coin. So
Right.
if you have a $10,000 account where you're willing to risk 1%, that means you could risk $100, and that
Right.
means you could buy one full Bitcoin, right?
Right.
Because if with one full Bitcoin, if the price went from 10,000 to 9,900, you would just lose the $100, which
Right.
is your max loss. Now, if the price went to 10,500, you would make $500 profit on that trade,
Right.
which would turn out to be a 5-1 risk reward trade.
Right, which would be awesome. Now, one of the things that a lot of traders will say is, well, hold up, Arsh. You just said one Bitcoin for $10,000. Doesn't that mean you're risking your whole account? Because you're putting your whole $10,000 account into that one position. And I would argue as an active trader that, no, it doesn't mean you're risking your whole account because your max loss is never zero, right? There's no way you
Yep.
should ever hold it down to zero. You shouldn't hold it down 50%. You shouldn't hold it below 9,900. So, there are some traders who are going to be more conservative. If you're trading stocks, you're trading in your retirement account or something like that, you may not feel comfortable putting your whole account into one trade. I personally, when I've been trying to grow small accounts, I have not only put my whole account into the trade, I've used all of my margin and buying power. So we don't have margin and buying power with cryptos as of right now. That may change in the future. But with trading stocks, with a $25,000 account, I have $100,000 in buying power. And so it wasn't uncommon for me when I was trying to grow my account to take an $80,000 position. But again, I use a $100 max loss or maybe 200 with a $200 to $400 or $600 profit target. I take the trade, I lock up the profit. Having said that, you do have that, back of your mind potential that what if something crazy came out right now? What if some really, really bad news came out and the stock did just flash down? Could I potentially lose more because of slippage between my stop order and the actual fill price? And so it may not be a bad idea, depending on your personal risk tolerance, to say, well, I'm only willing to risk 1% of my account. Having said that, I don't want to put more than 50% of my account in any single trade. But again, that's totally your discretion based on your risk profile and your comfort. Now, when it comes to emotional detachment, one of the things that is really important is to detach yourself from the profits and the losses, from the money, in the sense that you're just focusing on taking the best trades possible. And in that way, it is helpful that when we take trades, we're not stacking up $1,000 of $10 bills and looking at all this money that we're risking. It's all digital, right? It's just in the account. So that helps with the emotional attachment, which can be good and bad depending on how you react. What we want to encourage is that you don't get impulsive or emotional when you have a bad trade. That's really the important thing. And in fact, as I say that, you could also get impulsive after a really good trade. You could have a really good trade, you get overconfident, and then you could start being reckless. So you want to try to level out the emotional swings that come with trading. And it's easier said than done, right? Because trading can be stressful. The big winners are exciting, the big losers are disappointing, but you want to try to balance that out. And the best way to do that is to trade with a smaller position, because taking too big of a position can cause you to become emotionally involved, right? So if you watch SVU, what does Stabler say to Benson? Benson, don't become emotionally involved. You're becoming emotionally involved. So just like on SVU, we don't want to take positions that are too big. We get emotionally involved because that's when we get ourselves into trouble. All right, now next one, cut down trade size by 80%. So if you're having an issue where you're getting emotionally involved on your trades, where you're trading impulsively, you're starting to be irrational or erratic, you want to bring down your share size by so much that you're basically like, what's even the point of doing this? I'm trading with 150 shares. Well, that's good. You want to feel like, what's the point? Because then you don't care about the money, you're thinking about the trade. Make the trade be as good as it possibly can. The money doesn't matter. And then you just slowly increase your share size. And that's what I did for myself the last time I put myself into trader rehab, as I call it. I knocked myself all the way down to 100 shares, and I slowly built back up. The last time I did that was like 4 years ago, and since then it really was the kind of reset that I needed to just get myself back on a good path. So there's nothing wrong with putting yourself in that self-imposed trader rehab where you bring down the share size and you just focus on trading the setup as best as you can. All right, next slide is on discipline. Go for it, Arsh.
Yeah, so discipline is definitely one of the most important aspects of risk management.
Yeah.
You always have to have the discipline to be able to cut a loss before it gets too big. You don't want to get emotionally involved. You don't want to have second thoughts about exiting your position because you think it could come back. No,
Yep.
You need to have the discipline and just obey the rules that you set in place before you took the trade. So if before you took the trade you decided you were not going to lose any more than 500, you need to make sure that that's what you're doing as the trade progresses, because when we decide to change our mind during the trade, that's when it seems that things usually take a turn for the worse. It
Right.
never works the way we expect it to.
Right.
it didn't work the way we expected when we first took the trade. So why should it change all of a sudden now that we're at a loss?
That's a really, really good point. I try to remind, even today I had a trade where I got in it, I was up like 20 cents and then I was down 30 cents. And when it came back up to break even, I asked myself, should I hold out for the 20-cent win? Because I was up 20 cents before. And I was saying to myself, no, because how often do you take a trade that goes the wrong way and then goes back to being a home run? That never happens.
Right.
I mean, maybe it goes back to being a 10 or 15-cent winner, but it's almost definitely not going to be a home run. And I ended up taking a loss on it. I should have just gotten out sooner. So let's just say I'm not very good at being disciplined. Arsh, what can I do to improve my discipline? Give me some ideas.
Some of the best steps you could possibly take are, I would say, meditation,
Okay.
exercising, and emotional conditioning. So all of these things are going to help you improve your mental conditioning to be more in line with. Sorry. Once again, that I didn't have notes for that part, so I was just trying to come up on the spot and I totally lost my chain of thought.
That's okay. I can do the improved trading discipline if you want.
Okay, yeah, let's have you take on that one.
All right. So why don't you ask me the question?
Okay, Ross. So if I'm having issues with increasing my discipline when I'm trading, what are some of the steps I can take to improve my discipline?
Okay, so three good steps. Number one, meditation. Number two, exercise. And number three, emotional conditioning. So these are kind of interesting because meditation and exercise, they're about, in my opinion, and I'm not an expert on this, but the way I apply them to trading is that they're about making yourself comfortable being uncomfortable, getting yourself really good at experiencing discomfort without reacting to it. So just sitting still for 15 minutes and not thinking about stuff, just bringing your mind back to your breath, that's really not that easy. I mean, it's really quite difficult, and it takes a lot of patience because we all have so many things that we want to do. We want to do this, want to do that. I want to think about this, think about that. I don't want to just sit and meditate for 15 minutes. But doing that forces you, number one, to be patient. It forces you to become sort of comfortable experiencing discomfort. Exercise, going to the gym is the same way. You know, we don't run on the treadmill for 30 minutes. I don't because I enjoy doing it. I do it because I think it'll make me a better trader. And I found that it has helped me. So what it's basically having me do is be uncomfortable. I'm uncomfortable for 30 minutes when I'm on my bike or I'm running on the treadmill or whatever it is. And I'm forcing myself to get comfortable feeling discomfort. And I want myself to be comfortable feeling discomfort because when I feel discomfort in the middle of a trade, when I'm holding a loser and it's going down, I'm feeling discomfort. What's the best way to alleviate that discomfort? It's actually not to sell the trade. It's for the trade to go back to being a winner. And so it's to hold it and wait for that to happen. That's the easiest thing to do. That's the thing that's the most comfortable. The hard thing to do is to go ahead and sell it and take the loss. So exercise and meditation, they build your ability to withstand discomfort. And then emotional conditioning, it is sort of what you get from exercise and meditation. But what I really mean by emotional conditioning is that I want traders and students to get good at taking small losses. One of the things that I joke is that I'm a really good loser because I've had a lot of practice at it, but it's important to be good at losing because ultimately as a trader, even the best traders are going to lose 30% of the time. So you have to be good at it. Being a trader is not about not losing, it's about minimizing your loss. And so if you practice losing, you can build up emotional conditioning so that it's no longer a big deal. So how do you practice losing? The way to practice losing is as soon as you get into a trade, you set a 10-cent stop. And we would do that for trading stocks. For trading cryptocurrency, especially something like Bitcoin at 8,000, 10 cents is way too tight. But say you set a stop of $100 on Bitcoin, you set relatively tight stops. And what you'll find is that you will get stopped out a lot, but that's okay because you're going to have lots of small losses, and it conditions you to be okay with that. Okay, there's a $20 loss there, there's a $50 loss there, it's no big deal. And then when you do get that trade that turns into a winner and it's a $100 or $200 winner, you realize, wow, that one trade just made up for 5 losses. Like, that's awesome. And now when you're right only 50% of the time, you're actually making money because your losses are so small. And so it builds conditioning and it starts to build confidence, because we all feel more confident when we have more winning trades and when we're making money. So by having a better profit loss ratio and by working on focusing on A quality setups, we start to build that positive reinforcement cycle of, good trade, building confidence, another good trade, more confidence, more patience. And that's what you want. You want to spiral up, not down. So these 3 tactics can really help you improve your discipline, in my opinion.
Definitely very insightful.
All right, so let's see. Next slide is, there we go. Trading the best opportunities. All right, take it away, Arsh.
Yeah, so this is a great way for you to limit your risk, is making sure you're only going after the best trading opportunities that are available, the ones that offer high risk reward ratios. So you want to be able to have always the potential to make a 2-to-1 risk reward ratio, but it's not uncalled for to expect a trade to make you a 5-to-1 potentially. And the better, when you pick better trading setups, that potential is very realistic. So as we mentioned, always you want to make sure risk $100 to make 200 minimum to follow that 1-to-2 risk reward ratio. And of course, you can scale this to your account size. If you only want to risk $10, you want to make sure you're making at least $20 on the trade.
Sure.
And doing this is going to help you minimize your trading risk, because when you're chasing after only the best setups, you're putting yourself in a position where you're only exposed to the opportunities that are high probability and have a good chance of working out in your favor. But if you're constantly taking these setups that are subpar, they lack the quality, then there's a much larger chance that you're going to get stopped out. And it definitely doesn't feel good to get stopped out on a trade. So you want to make sure that when you are getting stopped out, it was on a trade setup that was such a great trade setup that it would have been totally worth it in case it had worked out.
Absolutely. Every trade has risk. So you can say it's a 2-to-1 profit loss ratio, but things happen. Sometimes you get slippage. Trade the best, leave the rest. It's just so key.
Right. And then, of course, you're going to develop the skill to trade better opportunities through education, screen time, and experience. So all of these things are going to help you with time make better trading decisions, and that's really going to help you develop as a trader.
Yeah. Yep. Absolutely. And again, this applies regardless of whether you're trading stocks, cryptocurrency, futures, Forex, whatever. It's just a common theme that you want to focus on the best quality setups. And even if that means you don't trade for a day or two, you're sitting and waiting, you're being patient, that's okay, because it's better to be break even than to be red, right? And especially as a confidence booster, you want to have the highest accuracy possible. So let's look at a couple of examples of risk management. All right, so why don't you walk us through these examples?
Yeah, definitely. So this was a setup that took place on Litecoin not too long ago. And what I just want to share here, or I'm sorry, this was actually on Bitcoin, not Litecoin. Yeah. So I just want to share the steps of incorporating risk management into your trade in this specific trade setup. So, of course, you guys may not understand the technical patterns that are taking place here. We'll talk more about those in the technical analysis section. But what's really important here is how you're managing your risk when you're taking a trade. So step 1 would be determining where you want to buy. So in this case, I decided that the buy point would be right where the arrow is pointing and where Ross is moving his cursor. That would have been an entry around 11,900 or so. Your next step would be to determine where you would place your stop loss in case you are wrong about the trade. And usually we like to place these at the low of the red candle before the breakout candle. So that turned out to be 11,550. So between your entry price, 11,900, and your stop price, that would be a total risk of $350 per coin.
Yeah.
So if you're willing to risk $700 on this trade, you could buy 2 coins at that breakout point of 11,900, right?
Yep.
So in order to achieve a 1 to 2 risk reward ratio, you would need to make at least double your risk. So if you're
Yeah.
risking 350, you need to make 700, and your first target would have been at roughly 11,000 or 12,600, which the trade did manage to reach, and that would have been a great place for you to start exiting your trade and taking profits. So
It's also not uncommon if you see a stock that that has a really logical setup with a very obvious pullback, that when you actually get to 2-to-1 profit loss ratio, you start to see some selling because this is such a universally respected risk management technique. So a lot of traders will actually put sell orders up here. As soon as they buy it, they put the sell order at their profit target. So if the stock squeezes up while they're sleeping, boom, they're out of the trade with profit. And so all of those sell orders added up can start to create resistance at these 2-to-1 ratios.
right, totally.
Yeah. So this
Yeah,
is
so here-
one of those. Go ahead. Yeah.
Yeah, this was just a good example of a 1 to 2 risk reward trade where you were able to risk $350 to make $700. And of course, there's going to be the potential to make even more on better trading setups, but
Sure.
there's always the potential that the trading setup fails. You know, in this case, the trading setup worked, but if it hadn't, what would you have done, right? You would need to have exited your position at where you determined your stop to be. And
Yeah.
if you didn't follow that rule, potentially the price could continue declining further, and you're going to take a loss that's much bigger than you expected. So you always want to make sure that before you take the trade, you're determining where you're going to enter, where you're going to place a stop loss,
Yep.
and then you have to be disciplined about exiting your position when either your profit target or your stop loss is reached.
Yeah. Yeah, that's absolutely true. And what's interesting here also is the fact that with this entry here, as an active trader, you'd be profitable. But if you were kind of doing this speculative investor thing where you buy it and then you're like, oh, I'm just going to hold it for a couple weeks, you end up being profitable, and then it comes all the way back down. And then do you keep holding it? Well, because you didn't make a plan for the trade, you probably do. And next thing you know, you're holding it down here, kind of either break even or at a loss months later. Meanwhile, we were in, out, booked our profit, and went on looking for the next good opportunity. So, that's really the
Right.
approach of being aggressive, looking for A-quality opportunities, and being willing to take them wherever you see them, whether it's in cryptocurrency, stocks, or somewhere else.
Yeah, definitely. That's a great point. So one tip I would mention is that in situations like this where the trade does work, you always want to move the stop to break even. That's something
Yeah.
we like to do. We like to apply that to our stock trading strategies, and similarly, we like to apply that philosophy with cryptocurrencies because once a trade is profitable, you never want to let it go back red because
Right.
not only did you give back your profit, but that just feels really terrible to have taken a trade that was initially profitable and you could have taken your profit and called it a day, but instead you decided to hang on and now it's a losing trade.
Yep, that's true. All right, so let's see. Let's look at the next example of risk management. I think this one is on, let's see.
This is
Ethereum?
Litecoin.
Sorry,
Litecoin.
Okay.
And this is a 15-minute chart. So same thing here, kind of with the previous setup there. These are short-term trading opportunities where you really have to determine what you're going to risk, or
Yep.
first of all, where you're going to enter, what you're going to risk from your entry, and where you would place your profit target and stop loss, of course. So in this specific case, the breakout point landed roughly around $164. And once again, if you guys don't really understand these technical patterns, don't worry because we'll teach you more in the technical analysis section. Right now, the focus is just
Risk
how you
management.
how you would incorporate the risk management into the trade. So if you had bought this at 164 and you followed the rule of placing your stop at the low of the previous red candle, that means you would have wanted to exit at roughly $159.
Yeah.
So that gives you a total risk of $5 a coin, right?
Yep.
If you have a max loss of $500, then you could buy 100 coins here. And since the trade did work, this actually reached all the way to it went all the way to 174, which would have put you at your 1-to risk reward ratio. So it's always good. You always want to at least scale out half at that 1 to 2 point. Yeah, there's going to be some situations where the breakout might lead to further continuation, and it is okay to hold at least half of your position in to try to get that resolution in your favor. But
Yeah.
that's not always going to happen, and just as you can see in this example, the breakout worked and then it immediately reversed. So you want to make sure that at least you're locking in some profit, and you're never letting the trade go back right on you. And
Right.
in case the trade didn't work, you have to be very disciplined about respecting your original stop loss. So
Right.
let's take for example, if you bought this at 164, and all of a sudden it drops right back down to 152.
Yeah.
This type of technical setup, it should have immediately worked.
Exactly.
And since it didn't, that
Gotta
that,
get
that
out.
should give you a warning. Yeah, that should give you a warning sign that okay, this trade might not work, and you really have to respect that stop loss because
Yeah.
as you guys can see, this thing after that breakout, it continued to decline pretty sharply, right?
Yeah.
So
Back down to 107.
yeah, so fortunately that breakout initially worked for any traders that took
Yeah.
it and took their profit. But if you
Yeah.
held on to this, it would have been a disastrous trade.
Yeah. Yep, that's definitely true. Also, FYI, guys, I usually I say profit loss ratio. So when I say profit loss ratio, the profit is first, so it's I say 2 to 1. But Arch says risk reward ratio, which is also totally valid. So his is inverse. So it's 1 to 2. But you guys get the idea. It's the same thing. It's risk reward, profit loss. They're interchanged, but either way, you'll notice that traders out there kind of will use those two. Be mindful though that nobody is going to be saying they're aiming for a negative profit loss ratio, because that would never be a good thing. So whether it's 1 to 2 or 2 to 1, it's always, your risk is half of what your potential is, or your potential is double your risk.
Right, right.
All right, cool. So that wraps it up for risk management, everybody. I hope you guys really enjoyed this class, and we're going to go and work on class 3 and then record that for you guys coming up next. All right, thanks, everybody.
See you guys soon.